Swiss watchmaking has a phrase you hear at every trade fair I have ever attended. Mid-tier brands are different. Different from what is happening in fashion. Different from handbags. Supposedly insulated from whatever is happening at the top of the market. I sat through it in 2022. The same line came up at Watches and Wonders in 2024. 3 months ago, I heard a senior executive deliver it again, 6 weeks before his company replaced its chief executive for the third time in 18 months. The phrase is wrong. The mid-tier is not different. It is structurally indefensible. By the end of 2027, at least 3 of the names on the list I am about to walk through will not exist as independent brands. Some will be acquired, some will be absorbed. One probably will not survive in any recognizable form. I will show you the math, and the first number that matters, 89% of all Swiss watch industry growth is happening above 50,000 Swiss francs. The Swiss franc figures alone tell you where this market is going. The luxury watch market has split into 2 buyer profiles, and the gap between them is widening. Under $3,000 you have Gen Z impulse buyers, the Casio, Seiko, and Tissot crowd. Above $11,000 you have collectors and investment buyers, the Rolex, Patek Philippe, and Audemars Piguet crowd. In between, the $3,000 to $11,000 mid-tier had no buyer profile in 2026. This is not a marketing problem, it is a math problem. According to Deloitte's 2026 watch industry report, watches priced above 50,000 Swiss francs make up just 1.4% of unit volume, but they generate 37% of total industry value and 89% of all industry growth. The Federation of the Swiss Watch Industry export data confirms the same directional pressure. Volume is compressing at the middle, and value is concentrating at the top. The remaining 11% of growth has to be split across every other brand, every other price point, in every other market on the planet. I am using 3 signals to forecast which brands fold first. First, revenue trajectory. Has the brand declined for 2 or more consecutive years against a backdrop of broader market contraction? Second, ownership pressure. Is there a private equity exit clock, a conglomerate cannibalization problem, or independent scale risk forcing a structural decision? Last, the Gen Z vector. Does the brand have any credible path to attracting the only buyer cohort growing in luxury watches? Deloitte's 2025 research confirms what most brand executives will not say out loud. Gen Z's primary entry point into luxury watches is the pre-owned market, not retail. They are buying on Chrono24 and Watchfinder before they are walking into boutiques. Any mid-tier brand that cannot capture that behavior is invisible to the cohort. 3 signals, 3 different failure modes. I picked 1 brand for each. Breitling was acquired by CVC Capital Partners in 2017 for around 800 million euros against an earnings before interest, taxes, depreciation, and amortization of 75 million. In 2022, Partners Group took the majority stake, valuing the company at $4.5 billion. That is a 5 times return in 5 years. CVC did exactly what private equity is supposed to do. They built it. They sold it. They started the exit clock. Then sales stopped growing. According to industry estimates, Breitling sales declined 3% in 2025, underperforming the broader Swiss watch market. UK turnover, where audited financials are publicly available, dropped from almost £90 million in fiscal year 2023 to under £60 million in the most recent report. UK sales specifically fell 25%. U.S. performance was pressured by direct competition from TAG Heuer and Tudor. In February of 2026, the Financial Times reported that CVC had marked down its remaining stake in Breitling to 0.5 times invested capital. Partners Group marked theirs to 0.7. In private equity language, that is a multi-billion-dollar paper loss spread across 2 firms whose entire business is making the math go the other way. Brad Pitt was hired as a brand ambassador. So was Charlize Theron. So was Erling Haaland. Partnerships with Aston Martin, the National Football League, and Six Nations Rugby were signed. Sales did not recover. Partners Group has indicated it sees Breitling as an initial public offering candidate in the 2027 to 2029 window. That window is the forecast. Either Breitling files for an initial public offering at a valuation well below $4.5 billion, or it gets sold to a strategic buyer. Richemont is the most logical candidate. They already own Cartier, IWC, Jaeger-LeCoultre, and Vacheron Constantin, giving them the infrastructure and distribution to absorb Breitling without meaningful overlap at the top end. A Chinese conglomerate looking for European luxury credibility is the other scenario. The clock started in 2017. It rings in 2027. LVMH owns 8 watch brands: TAG Heuer, Hublot, Zenith, Bulgari's watchmaking division, Gerald Genta, Daniel Roth, Louis Vuitton, and Tiffany's watchmaking. 8 brands, all under the same conglomerate, all fishing for buyers in overlapping price tiers. In 2025, LVMH's watches and jewelry division revenue declined 1% to €10.5 billion. Profit for the first half of 2025 was down 13% year-over-year. That followed 2024, in which the same division saw a 28% profit slump. TAG Heuer was the brand absorbing most of the damage. UK sales fell 28% in 2024 alone and are down 36% since peaking in 2022. The leadership response was to rotate chief executives. Julien Tourneur was named CEO in 2024. 6 months later, he was moved to Hublot. Antoine Pin replaced him. 18 months later, in January of 2026, Pin resigned, reportedly over strategic disagreements about the connected smartwatch program, which has consumed an estimated 250 million Swiss francs of investment over the past decade. Beatrice Goesglass was appointed in March, effective May 1st. 3 CEOs in 18 months at one of the most recognized watch brands on earth. In 2025, TAG Heuer paid an undisclosed sum to replace Rolex as the official timekeeper of Formula One, in the most expensive sponsorship in luxury watchmaking. Sales did not recover. The forecast: TAG Heuer does not fold because LVMH will not allow it. But TAG Heuer, as we currently understand it, stops existing. Either it gets aggressively repositioned, the connected line killed, the Formula One partnership rationalized, the brand pulled significantly upmarket or significantly down, or it gets quietly absorbed into another LVMH watch brand, possibly Hublot, possibly something else. By 2027, the TAG Heuer that lost 3 CEOs in 18 months will not be the TAG Heuer on the shelf. Oris is the hardest forecast in this video. I want that on the record before I make it. Oris has been independent since a 1982 management buyout. The Herzog family has run it for nearly a century. It makes good watches. The Caliber 400 movement is a genuinely impressive piece of in-house engineering. 5-day power reserve, 10-year service interval. The brand's environmental positioning is real, not marketing. People who own Oris watches tend to like Oris watches. None of that is the problem. The problem is the price band Oris occupies. Most of its catalog sits between 2,000 and 5,000 Swiss francs. That's the exact center of the dead zone. Too expensive to be a Gen Z entry purchase, too cheap to function as an investment piece. CEO Rolf Studer told Luxury Tribune in April 2025 that Oris raised United States prices 13% just to offset Swiss franc appreciation against the dollar. Not for margin, not for repositioning, just to stay even with the exchange rate. The Swiss franc appreciated roughly 14% against the dollar over 2025 and another 3.5% in the early months of 2026. Gold crossed $5,000 an ounce in January. Morgan Stanley and Lux Consult's annual Swiss watch report flagged currency headwinds as the defining structural risk for independent mid-tier brands, specifically brands that can't offset franc appreciation through conglomerate cross-subsidization or high-margin top-end sales. Independent brands have no parent company to absorb that pressure. There's no LVMH cushion. There's no private equity runway. There's the family, the cash flow, and next year's collection. The forecast for Oris isn't bankruptcy. Independents at this scale rarely go bankrupt. They get bought. Citizen is one obvious candidate since they already own Frederique Constant, a brand sitting in almost exactly the same price tier, facing almost exactly the same structural pressure. That tells you Citizen understands the mid-tier acquisition logic. Seiko has been quietly building its luxury portfolio. Swatch Group would close the loop on the brand it sold in 1982. Independence is structurally indefensible at this price point. Independence ends. If you own a watch from any of these three brands, this is not an argument that you bought wrong. The watches are good. They will keep working. The mechanics do not care about ownership structure. But if you are considering a mid-tier purchase in 2026 specifically because you believe these brands will be making them in 2028, that calculation is doing more work than the math supports. The brand sitting in your hand may not be the brand you think it is by the time you take delivery. That's the part the press briefings are not covering. The phrase I opened with, mid-tier brands are different, is still being said at trade fairs. It was being said when CVC marked down its Breitling stake. It was being said when TAG Heuer cycled through 3 chief executives in 18 months. It will be said at Watches and Wonders next year by people whose jobs depend on it being true. It is not true. The middle tier is not different. It is just slower to notice. 3 names, 3 failure modes, 18 months. Whichever one falls first will look obvious in retrospect.